Hello again. So now looking at ethics, you've learned most of this from F8, and it's a similar sort of thing where you have to identify, evaluate and respond ethical threats. Okay, and first of all, threats to what? Threats to the fundamental principles. So let's just go with the fundamental principles. Integrity means being straightforward and honest. So straightforward and honest in all your dealings with people. Okay, so always have integrity. The next thing we should always have is objectivity. So what does objectivity mean here? That just means no bias, no conflict of interest that will influence our business judgments. Professional competence means keeping up to date and acting diligently. Okay, so keep up to date, work hard, act diligently within appropriate standards when giving your service. Okay. Then we go on to confidentiality. And confidentiality just means between you and the client, so no disclosure to third parties. So no disclosure of information you've got to third parties unless it's been agreed with your client, of course. You can, however, disclose if there is a legal duty for you to do it or a professional duty for you to do it in terms of the public interest, okay? But the point is, don't take personal advantage of the fact that you've got this information and given it to third parties. Then finally, professional behaviour in a manner consistent with the good reputation of the profession. So in a manner, I've put better, in a manner consistent with good reputation of the profession of an auditor. Okay, so always act professionally. So just don't get into any behaviours which might bring discredit to the profession. So they're the fundamental principles that ethically we try and stand by. So what we've got to think about is, well, how are we going to identify threats to those principles? And the identification basically comes from different things, all of which you've seen before. So first one would be self-interest. Okay, if you can gain something, then you might not act with objectivity and independence, might you? The other thing is, when you're reviewing yourself, you might not be as critical, as sceptical as you would otherwise. Okay, so if you're auditing the financial statements that you prepared, then that's obviously a threat to objectivity and independence. Advocacy. Here the auditor is expected to defend or justify the position of the client and act as their advocate. And obviously if you're doing that, then you can no longer be independent or objective. You might be intimidated. So that would be a threat to acting ethically all the time, intimidation. So intimidation to such a point that you just can't act independently because you're scared of intimidatory threats, such as we'll take our work away from you and all the revenue away from you if you don't agree to do as we say. And then finally, familiarity. If you get too familiar with a client, you may not be as ethical as you once were. So if you have too close a relationship, maybe because you've been working with them for so long, for so many years, you may not be as objective, as professionally competent as maybe you otherwise would have been. Okay, let's have a look for some examples then of all these threats. Okay, and the first one I'm going to come across is, and there's plenty of these, and I'll just go through a few of them with you, and you can look at the textbook for the rest. Financial interest. So what you've got to look for is the degree of control that we've got over it and the nature of the interest. So the more control we've got, the higher the risk. So look at the seniority of people involved. Can they control the situation? Okay, so if you've a tiny financial interest, then just dispose of it. But the interest should be disposed of, or maybe just remove the team member from the engagement if they've got a financial interest. Loans. So if the client's a bank, they give loans, don't they? And the loan is on commercial terms, then it's okay. So banks, okay, if you get a loan from a bank, as long as it's on normal financial terms, that would be okay. But any other loans is a self-interest threat and should be avoided. So no other loans. You can't be having, can't be getting a loan from a client, because if you do, or you loan to the client, then it's in your interest that they do well. Close business relationships is what I want to have a look at next. So that's the familiarity one, isn't it? Close business relationships. Okay, so a material joint venture may be with a client. No, can't have that. So avoid any big joint ventures with a client. Buying things from a client, that's okay if it's on normal commercial terms and if it's on the normal course of business. Okay, family relationships. Okay, again, think about the seniority of the people involved. Can they exert control? Can they exert significant influence? If they can, then remove them from the audit team as well. Okay, recent employment with the client. Again, if the member thinks they might soon be employed by the client, that should be disclosed immediately. And there's plenty more. I'm not going to go through them all with you, because you can have a look at them. You can read as well as I can on the interactive textbook that you've got there. Okay, so we point you to that in the next bit. However, we are going to come back and deal with a bit more to do with ethics, to deal with safeguards and things like that.